During the 2014 Scottish referendum, the significant influence of polls on the stock markets came to light. Pollsters stood to make huge financial benefits by selling polls to hedge funds before passing them on to various news outlets. Polls significantly influence the mindset of the investors and hence move the stock markets. The more conflicting the information held within the polls, the bigger the move. When David Cameron swept the UK elections in 2015, he promised a referendum on the UK's stance in the EU. Hedge funds were quick to realise that if the Scottish referendum moved markets, the UK referendum would simply take it by the scruff of the neck. I'm Dean Pereira, part of the Investor Relations team here at Menance, and the focus of our story here today is not on Brexit itself, but on the intricate games at play by the hedge funds, pocketing hundreds of millions of dollars during the pound sterling's darkest hour. Why are pollsters and hedge funds a marriage made in heaven, you may ask? Well, hedge funds have two primary goals when it comes to this novel information. Get to it first, and in getting there, be more right than the rest of the world, even if they are wrong. Polls are the best access to this early information with their vast outreach through various channels. Most hedge funds either directly own pollsters or are closely connected to and heavily fund them. So let's trace the series of events. On the 23rd of June 2016 at 10 p.m, the UK referendum polls closed, and shortly afterwards, Nigel Farage, the face of the Leave campaign, issued a solemn statement conceding defeat. Following this, YouGov, one of the UK's most closely followed pollsters, declared that the UK had voted 52% to remain and 48% in favour of leaving. Following the issue of this news, the pound began to rise and by 10:52 p.m. had reached the equivalent of $1.50. What most people were unaware of until a recent Bloomberg report was that YouGov had conducted a private poll and sought immense financial benefit by selling the poll to a hedge fund. You see what the problem is now. The hedge funds were able to capitalize on this issue and were able to go long on the pound much before the rest of the market caught up. Simultaneously, Survation, an alternative pollster, had conducted its own poll and sold it off to multiple hedge funds, accurately predicting the Brexit and allowing them to place cheap bets on the crash of the pound. As the hours rolled by, the election results from various cities began to come to light, indicating a strong support for the Leave campaign. And it was now that the penny, or rather the pound, had dropped, bottoming out at $1.32. By this time, the hedge funds were raking in the money. The influence of the YouGov poll for the Remain campaign was through the roof, and it resulted in a herd mentality of sorts, which meant that the pound fell a lot slower than it actually should have. While most of the market were losing millions, it was now a walk in the park for the select few fund houses. Polling has been around for a long time and is easily influenced by the curiosity of the general public, be it political tussles, sporting events, or even talent competitions. Hedge funds have been at the forefront of capitalizing on this early information. The Bloomberg report notes that the solicitors of these events were comfortably surfing through grey waters without breaking any legal boundaries, but it certainly does enough to raise questions about the ethics within these powerful institutions. The use of such private information for financial gain is vastly prevalent in the modern world. Newer reports bring to light similar arrangements during the recent Italian elections, and who is to say it won't play a big part in the upcoming 2019 general elections, banking on the already volatile Indian stock markets. We would love to hear your opinions on this matter. Thanks for watching.